BlackRock's CEO just shocked the crypto world. Don't sell your Bitcoin yet. Bitcoin just dropped 12% from its all-time high. People are panicking, but history shows dips like this might actually be the setup for the next massive move. And with major US legislation and ETF decisions coming this fall, this could be one of the most important warnings of the entire bull run. Let's break it all down. A 12% drop in Bitcoin's price can feel dramatic, but let's put it in perspective. For a volatile asset like Bitcoin, a correction of this size is completely normal. On a long-term logarithmic chart, which helps visualize the bigger picture, this 12% dip is just a minor blip on a much larger upward journey. It's a crucial reminder that what feels like a crisis in the moment is often just noise in the long run. In fact, we've seen this movie before, even in this bull market. We've already weathered multiple pullbacks of 15%, 18%, and even 22%. Each time, the market absorbed the selling, shook out nervous hands, and built a stronger foundation for the next leg up. These dips aren't a sign of weakness. They are a healthy and necessary function of a bull market, allowing it to catch its breath. Even the biggest shocks in recent memory were contained. Events like the Liberation Day flash crash only pushed the market down by about 31%. That's a world away from the 80–90% collapses that define a true bear market. The fact that the market recovered from those shocks and pushed to new all-time highs demonstrates the incredible underlying strength and demand driving this cycle. But here's the most compelling evidence. We track over 30 key indicators that have historically called cycle tops with incredible accuracy, like the Pi cycle indicator and the MVRV Z-score. And today, the number of those indicators signaling a market top is a resounding zero. Not a single one. None. This data provides a clear, objective framework. It tells us that despite the short-term fear, we are not seeing the euphoric conditions that define a market peak. According to the data, we are nowhere near a true cycle top. So if history is any guide, this dip isn't the end. It's a local bottom, a consolidation phase, and the potential launch pad for the next major move higher. October is shaping up to be huge for crypto. We have the Market Structure Bill, sometimes called the Clarity Act. Insiders from Washington, like former White House crypto director Bo Hines, say the US government could soon expand its own Bitcoin reserve. That's right, America buying Bitcoin. Imagine what that does for demand. So while retail traders panic over a small dip, institutions and governments are quietly preparing for the long game. Now here's where the story takes a fascinating turn. Let's talk about Larry Fink, the CEO of BlackRock. This isn't just any CEO. BlackRock is the world's largest asset manager, a financial titan controlling over $9 trillion. For years, Fink was one of Bitcoin's most prominent critics. Back in 2017, he famously dismissed it as an index of money laundering, seeing it as a speculative bubble with no real value for serious investors. But fast forward to today, and the tune has changed dramatically. In a complete reversal, Fink is now calling Bitcoin digital gold. He's comparing it to the oldest, most trusted store of value in human history, acknowledging its potential as a hedge against inflation and a safe haven in times of economic uncertainty. This isn't just a change of heart, it's a paradigm shift, legitimizing Bitcoin in the eyes of the entire global financial system. He even went a step further, calling Bitcoin an international asset and a hedge against fear. Fear of what? Fear of your government devaluing your currency. When central banks print trillions of dollars from thin air, the money in your savings account buys less and less. That's currency debasement. Fink now recognizes that people worldwide are turning to Bitcoin to protect their wealth, using it as an escape hatch from poor fiscal policy. So let this sink in. The man who manages more money than the GDP of most countries is now publicly bullish on Bitcoin. When a figure of this magnitude speaks, the institutional world listens. His endorsement acts as a green light for other conservative pools of capital, like the pension funds managing your retirement and the sovereign wealth funds managing national wealth. The race has begun, and BlackRock just fired the starting gun. In just 1 week, 14 publicly traded companies added more Bitcoin to their treasuries. That's 4,300 Bitcoin, while only 3,150 were mined. Do the math. Demand is outpacing new supply. The only way price goes lower is if existing holders sell. And every dip, weak hands sell into strong hands. Institutions scoop it up. That's how bull markets build momentum. But the story of institutional adoption goes far beyond Bitcoin. In a landmark move, the U.S. Department of Commerce is preparing to issue official economic data directly on the blockchain. Imagine critical information like GDP figures and trade data recorded on an immutable, transparent ledger. This isn't just posting numbers online. It's creating a single source of truth, cryptographically secured from tampering. For a government agency, this ensures unparalleled data integrity, representing a monumental vote of confidence in the technology. The billion-dollar question is, which blockchain will they choose? The frontrunners are the titans of the smart contract world. There's Ethereum, the original pioneer, now more scalable and energy efficient with the largest ecosystem. Then you have Solana, the high-performance contender, known for its lightning-fast speeds, and of course, there's Cardano. Its academic, research-driven approach emphasizes security and reliability, qualities incredibly attractive for a government use case. The race is on for this prestigious partnership. Speaking of Cardano, another major catalyst is brewing. The decision on a spot Cardano ETF has been delayed, with the new deadline now October 26. For anyone new to this, an ETF is a game changer. It allows investors to buy shares representing ADA through regular brokerage accounts, just like a stock. We saw the explosive impact this had with the Bitcoin ETFs, which unlocked billions in new capital. A delay isn't necessarily bad news. It means regulators are doing their due diligence. But it does make October 26th a pivotal date. If that ETF gets approved, it would unleash a massive wave of adoption by opening the floodgates for institutional capital. From a trading perspective, the chart for ADA looks incredibly primed. It has established a rock-solid base of support around the 83-cent mark, a level where buyers have consistently shown up in force. Should the market structure remain bullish and the ETF news be positive, the initial price target sits around $1.20. A break above that could propel ADA towards $1.50 or higher, a potential 100% plus move from its support. Ultimately, this all points to a powerful theme. The next major wave in crypto will likely be led by altcoins with deep liquidity. High liquidity means an asset can be bought and sold easily in large quantities, a sign of a mature market that big institutions require. That's why Ethereum, Solana, and Cardano are so perfectly positioned. They combine groundbreaking technology, real-world use cases, and the potential for massive capital inflows from ETFs. They have the liquidity to absorb that demand, making them the top contenders to watch. So here's the takeaway. Dips are normal, institutions are buying, and BlackRock's CEO himself now calls Bitcoin digital gold. Will Bitcoin smash through 150K this year, or do we see one more big correction first? Drop your thoughts in the comments, and don't forget to subscribe for more crypto breakdowns every week.